Yeah.
Okay.
Plenty of chairs up front.
And the sound is on and we are
Okay.
good. I'll just keep letting people in.
Yes. All right. Welcome, everyone. We're going to go ahead and get started. It's been an action-packed afternoon ahead of us. My name is Sarah Hanson. I'm the Executive Director of Greater Portland Landmarks, and I'm really thrilled to be offering this today. We had so much interest that we're going to have to offer it again. So probably stay tuned for part 2 in the fall. I just wanted to quickly say too that when you came in and sat down on your chair, is a little fact sheet about some legislation that we are going to have pending in the session. We are still waiting for the bill number from the revisor's office, but we are one of approximately 3,000 bills this session. So we hope to have that soon. And I think hopefully all of those talking points will make a lot more sense after you heard from Mike and John today. So again, welcome. We were expecting about 30 people, so we may have some stragglers in, and also say welcome to everybody joining us on Zoom. We'll be monitoring the chat for any questions. And so feel free to throw them in there as they come up. So again, welcome everyone. I'm going to go ahead and turn it right over to Mike. And then afterwards, I'm going to have my lovely colleague Carrie say just a few words about the space that we're in, the Woodford's Club. Because we're excited to be here in the historic building. So come on up. Thanks.
Thanks, Sarah.
Give me 1 second, Mike, to get the screen so the folks online can see it. Okay. All right. Test that. You press the sideways button, does it go?
The arrow.
Yeah. Okay. It's doing it on mine. So hold on 1 second. Sorry, give me 1 second here. I swear we tested this.
My name is Mike Johnson. I'm the tax credit coordinator for the Maine Historic Preservation Commission. For those of you that don't know, we're also the State Historic Preservation Office for the state of Maine. There's an office for each of the 50 states that does basically what we do. We deal with all the National Register nominations in the state. We have a commission that actually gets those listed and forwarded to the National People Secretary of the Interior in Washington, D.C. They actually list buildings. We also do all the Section 106 compliance work. Any project in the state that gets any form of federal funding has to get a review under Section 106 of the National Historic Preservation Act, so we deal with that. We deal with historic preservation fund grants and easements to go with those grants. And there's several other things that are all.
Right.
I know. Thanks.
There's no microphone to speak into.
It's the owl. That's yes.
So anyway, I'm here today primarily, I think, because Munjoy Hill was recently certified as a historic. And all the buildings that are within that district that are designated as contributing to the historic district are eligible for historic tax credits.
Well, I can just do it, Mike, if you want to just indicate. Okay.
So the state credit and then there's a federal credit, and I'll explain how these two things work together here in a minute. Obviously, the federal credit is a credit owed for taxes owed to the IRS. It's 20% credit, so 100,000 in qualified rehab expenses equals 20,000 in federal credits. Those qualified rehab expenses just kind of carry forward to pay off any federal taxes owed, unless the credits are purchased by someone ahead of time. You can consolidate those credits, or people buy them ahead of time, so you have money to put in your project. Some of the banks do this and other groups. I don't know much about those little details, so there's other people. John Egan is one of them who's here today, so he can explain that much better than I can. The federal credit is not refundable. It has to be claimed in the year that the bill was placed into service, and it's claimed over a 5-year period. So you get 1/5 of that credit in each of the 5 years after the bill is placed in service, and there's no cash. So the way we set this up is if for the what we call a substantial rehabilitation credit, if you go through federal historic tax credit, you automatically get state historic tax credit. So it's a, well, it is what it says on the thing, 20% federal, 25% state. So that right there is 45% credit. And then if there's affordable housing, it's also boosted an additional 10% at this point. That started out at 5. The goals that were intended to be met through affordable housing were not met for a certain number of years, so that continued to increase. So now it's at 10%, and that's as high as it'll go. So the basic, there's some basic eligibility requirements for state and federal tax incentives. The building has to be determined as certified historic structure. That's like an IRS term, basically. So as I said earlier, all the buildings that are designated as contributing to Munjoy Hill will qualify for this tax. The new capture period is over, and it can be used for whatever you choose, or you can sell a building. You also have to retain ownership of that property for 5 years after you claim credit. In addition, the project has to meet the IRS substantial rehabilitation test. That's in order to get both of these credits, which basically means that your rehab expenses have to exceed the adjusted basis of the property, which is essentially the purchase price minus the land value and a few other things that get thrown in there by more specific IRS definition of what that is. For the small project credit down here, it just has to incur qualified rehab expenses of between $50,000 and $250,000. There's no substantial rehabilitation test. The small bit for that, you only get 25% state tax credit. That you have to meet that substantial rehab test to get the federal credit. So the entire rehab, then all the rehabilitation work has to be found to be in accordance with the Secretary of the Interior standards for rehabilitation. So the eligible items that are allowable for the tax credit include, a good rule of thumb is basically anything on that building, anything on that historic building that can include even modern additions, not new additions, but even additions that may be outside the period of significance of the building can qualify for tax credits. The things that don't qualify are things like appliances, carpets, parking lots, landscaping, and new additions. If you're putting a new porch on a building, if you're putting a new elevator addition on a building, onto the exterior of the building, that will not qualify. If you do that inside the building, it does qualify. You know, things like electrical work, insulation, new roofs, painting, all that stuff qualifies. So, this is a three-part application process. The first part of the application is the evaluation of the building to ensure that it contributes to a historic district or it's eligible for listing in the National Register. The part one is relatively easy for a building that's in a historic district to show that it does or does not contribute. You say, I'm so loud that closed the door. If the building is not in a historic district, it has to be found individually eligible. It's a little bit higher threshold. Generally be considered contributing to a district. The essential exterior mass, shape, general fenestration, as long as those stories have been lopped off and hasn't been completely altered, it's probably going to contribute to the district if it's from the same period. With regard to individually listed, all the interior, the floor plan, things like that, all have to have some semblance of integrity as well. So that's the additional kind of threshold that needs to be met for those. So the second part of the application is really kind of the nuts and bolts of the proposed rehabilitation, and these all come with you know, you have to have project plans, you have to have site plans with photos keyed to those site plans on the exterior. You need to have floor plans, photos keyed to the floor plans to show what the interior looks like as well. This all has to be done. You know, it doesn't have to be done. I strongly recommend that this all be done and the part two is approved before anyone ever begins work on these projects. If you start work and it's not completely documented before you start, it can cause issues with getting certification. It's not impossible, but it does make it much more difficult. And as I said before, all the work has to meet the standards, and the standards are out there, but they're, the nicest way I can say it is they're a little bit nebulous. They're not super cut and dried. They require a little bit of interpretation. It's the National Park Service's ultimate interpretation of those standards that have to be met. What my role with the commission is to help you to review your project plans and help you get that application together and get the rehabilitation to a point where we feel that it's something the Park Service is going to approve. If there's, you know, if I get a part two, for instance, and I have major concerns about it or something, I will call you up and say, well, or whoever your designated contact is. And explain that, you know, we have some concerns about, you know, a couple of these issues here. What can we do to make this a little bit better, better to conform with the standards and that kind of thing. So that's kind of how the part two application works. And then that is also accompanied by project plans, specifications, things like that. So that, you know, it's a very thorough review. And I feel like that thorough review is what's helped this program continue to have success across many states and across the country. And generally has fairly bipartisan support in the legislature, I would say. And I think people are more comfortable with the idea that this is a very thorough review, and I think they appreciate that. So once the part two gets approved, you proceed with construction complete to show that you did what you said you're going to do in the part two. Submit those photographs. We review that information, and if everything looks like it was supposed to, excuse me, right? We will say yes, the project was done in accordance with part two, yes, standards, and then you're eligible to get your tax credit. So the way this program is administered, as I just said, we consult with the applicants and the project team. At our level, once we get everything, once I have an application, I feel like it's ready to be submitted. We forward that on to the National Park Service. They have in somewhat in consultation with our office. So this is done in all parts, 1, 2, and 3. I need to back up to and state that. So we have 30 days to review each part of these in our office. Then they get forwarded to the Park Service. The Park Service has 30 days to review it. You can also submit part 1 and part 2 at the same time, and that makes it so part 1 and part 2 are both reviewed within 30 days of our office and 30 days of the Park Service. So that does save some time on that and other things. And then the IRS certifies the expenditures. I'm not sure that there's I don't think there's a major process for that. The IRS does have a worksheet that you fill out when you submit your taxes. I think John can probably speak to that a little bit more. I don't know that you're required to submit receipts and all that information, but if you get audited because they question something, and you would obviously need to have those. And these are just the photos I put up are examples of projects that have been certified by the National Park Services. Just landlocked, very simple building in downtown Falls that was certified in 2013 and converted to medical offices. They did actually have quite a bit of work on the masonry and pretty cool. This program especially need substantial maintenance and roofs and things like that. And then this is just the way the small project credit works. It's all done within the state of Maine through our office. Again, we just review everything and Maine Revenue Service certifies the expenses, and it's a similar process to the IRS. This is the Fox School that was converted to affordable housing, certified in 2019. So as I said previously, I would say this program has been pretty widely used and pretty effective. I haven't updated these numbers since the last one of these I did, so it's about a year old as far as the numbers go. They've picked up a little bit since then. I was actually surprised that the program does not seem to be especially
Yeah.
Good. Felt like I was inhaling dust for a minute there. So you can see that there's been our smallest project so far was 55,000 in qualified rehabilitation expenses. Largest, it's probably even above 35 million now. So there's a huge range of projects. We had, for instance, we had a project in Rangeley, the Rangeley Inn. The owner, basically all I did was replace his roof. It was, no, I think that's the $55,000. What it costs to replace the roof. Put in his small project credit rehab and got a new roof. And got a major discount on it. This I've always enjoyed working on this program because I have to say it supports a lot of jobs in the construction industry. It helps put development where there's already existing infrastructure. It recycles old buildings. You know, these old buildings, I may be preaching to the choir here, but these old buildings have, great materials that you could never afford to rebuild new with now. It's been great for Maine's economy, I think. So, it's been great for historic preservation. I mean, we've seen a whole range of different types of buildings, rehab, these are a couple of storefront buildings. I believe Rennie's has used this program for 3 of their buildings in the state so far. We've seen convents, churches. There's now, there's a military barracks on Great Diamond Island that's been converted, lots of mill buildings, manufacturing buildings. Houses, duplexes converted to bed and breakfast, things like that. And then there's been a lot of affordable housing put into public schools and things that are particularly in downtown areas. I had a slide up to show Coney High School earlier. That in many of these schools, many of these buildings have just sat vacant for decades before this program. And what this program really does, and the intent behind it is to, as many of you probably know, it's extremely expensive to preserve and rehabilitate a historic building. So it's hard to maintain them. And the idea is to offset that additional expense. It would probably be cheaper to go out, buy land, construct a new building than it is to rehab some of these historic vacant buildings. The percentage of credits that's available through this program really helps offset that difference. So it makes it so it's actually economically viable to go into these buildings and fix them up and turn them into something that is useful and will keep them around for another, several decades. So this is kind of just more of what I just was explaining. Here you can see this is the Squire Burley building in downtown Hallowell. It had it's the building that Slate's Restaurant is in, if any of you are familiar with that. It caught on fire in I think it was 2008 or 2009 and suffered serious damage. Slate's had to move out to another building next door. But this building was rehabbed and it's still downtown and that's what it looks like today. And this is just a list of the various different types of buildings that we've seen rehab through this program. Go to the next one. The other thing that I enjoy about this program is that it's pretty widespread. It's not all within all the cities. It's worked 14 of 16 counties. There's been projects in. So we can go to the next one. And then these are just a few of the case studies. I may just skip over that for now. And so do we have plenty of time or
Anytime, yeah.
we run through these?
Yeah.
Does anybody have any questions before I continue on? Yeah, go ahead.
Mike, you might mention briefly how nonprofit organizations can use the state.
Honestly, I am not 100% sure how that works either. I think John explain that much better than I can.
Okay.
Yeah, we'll save that.
Good.
Is there a dollar cap or a limit cap on conversion to number of units for residential housing or a dollar cap in the amount of upper limit of the dollar expenditure?
It's you can earn $5 million in credits per project. So any building you rehab, you get up to $5 million tax credits. And they've even adjusted that so that if you have a mill building, for instance, you could potentially rehab a portion of it, like a floor of a mill building, get that $5 million cap, put it in this, put that floor back into service, get the $5 million cap. The following year, you can do that again the next floor. So they've really tried to make this as usable as possible, particularly for big.
It wouldn't have to be crossed out on a different ownership, it could stay in the same ownership.
Correct.
Can it be coupled with new construction, is this just strictly preservation and rehabilitation?
It can be coupled with, I mean, you can't get credits for new construction. But there can be, you can build new buildings on the site of a historic property. That can be difficult to do, but it depends on the size of it, all that kind of thing. The standards have the guidelines for that as well. And I can certainly help you figure that out. Yes.
I'm just curious, I know that your list wasn't completely inclusive of everything. Does it include structural integrity improvements? Because I know, a lot of those buildings have structural integrity issues, and does it also include remediation for things like asbestos?
Yes, absolutely. Yeah. Lead paint, got this. All those things.
Okay.
Is any of it retroactive? In other words, let's say you just did a major rehab on a building or a new slate roof. Then you decide to take the project further. Is any of it retroactive or can be grabbed from the past?
It depends on, I think it depends on how far in the past it was. I mean, if it was like last year, you might be able to. You would need to at least have some photos of what it looked like before you start the work, that kind of thing, but, And this program is based heavily on documentation. That's kind of why that is. They want to make sure that, nobody's gone through and like got a building and then come in and said, oh, I'm gonna rehab this now. Because that would be easy to do, probably a cheaper way to go about it, frankly. So this is the Gerald Hotel, which was rehabilitated in 2011. Was converted to affordable housing for elderly people. I believe the Gerald. I believe this building is individually listed, even though it's obviously gone through some alteration in the past, lost some pretty significant exterior features. But it still had quite a bit left as well. The old ballroom, I guess you'd call it, was still relatively intact. You go to the next one, please. So after they rehabbed this, after 2013, Tony Castro is a fantastic artist. He does a lot of mural and stenciling restoration around the stage. Does excellent plaster work. He went to the ballroom. They actually picked up an extra grant to help pay for this, I believe. And they were able to restore this ballroom pretty immaculately, absolutely beautiful. Good. They also restored some architectural detailing on the exterior as well. The building had a lot of maintenance needs as well, so that all got taken care of. Many of these buildings were dealing with issues of egress and code issues, ADA accessibility and those kinds of things. Those are all allowable as long as they're within the building. I don't think you can get the credits for building like an exterior ramp necessarily, but for other things like egress stair, if you have to put a lift in the building or something like that, those all qualify as well. You got the next one. This was 449 Main Street in Rockwood. It was just an abandoned building. It's been empty for decades. This project was done pretty early after the tax credit program was passed in its current form. It was all just boarded up. The brick needed to be cleaned up, repointed, all the usual maintenance issues, new roof. Go ahead. And this is what it looked like after they completed. Okay, thank you. This is terrible. And it was converted to retail space, and I believe it's still used for retail today. And you get the next one. This was a big project in Dover Foxcroft. It was in some of the papers, you may have heard about it. The American Wool Company mill. It was converted to hotel mixed use, so hotel retail space. And some apartment units as well. And this is just a big kind of sprawling middle complex of buildings. They didn't quite get to every single building in this complex, but they did do several of them. And it's interesting too, because they kind of span quite a period as far as when they were constructed in different styles. You can go to the next one.
There were 11 sources of funding in quite a task of getting all those sheep through the gate.
Yeah. Yeah, so like this mill, for instance, this is early 1900 mill. Mostly constructed concrete. I mean, most of the ones we deal with in the state are usually brick. So, you know, it's different, all kinds of different buildings. This building here with an earlier mill, sort of I should say, almost Gothic revival or something. It was a wood framed mill building with a slate roof that was restored. Kind of brought back to what it looked like. Go to the next one, please. And then these are just kind of what the interior look like. Pretty much what you expect from an abandoned manufacturing building. And then, you know, just turn into absolutely beautiful apartments and living spaces and hotel rooms, restaurant and retail spaces. You know, the next one. This is 17 Alfred Street in Biddeford. These folks, this is a husband and wife team. They've done a few projects now around Biddeford. They do smaller projects. I believe they do everything themselves. I mean, I think that he does a lot of the actual construction himself. They put the applications together themselves. They don't use consultants. And this is one thing I skipped over, and I apologize. I generally recommend that people hire consultants. It's not necessary. You don't have to do it. Depends on how busy you are, how much time you have to put into this application process. But the consultants. The consultants can take all the project plans from an architect. Pull everything together. They can work with an architect to advise them on what will or won't meet Secretary of the Interior standards. They're familiar with the standards, they're familiar with the program. And the idea is they can work with your project team and get an application together that is pretty much ready. I mean, there may be a little bit of back and forth with us, but they usually know what they're doing. And we can usually get these projects done quite a bit faster that way. But back to what I was saying was this is an example of a building that was rehab without the assistance of an architect. They just have a good kind of preservation mindset with these projects, and they do excellent work. This one's actually featured in the National Park Service report on tax credits. You go to the next one, please. Oh, this is the Oddfellows Hall in Brooklyn, Maine. It was a beautiful building that was actually rehab for built building on the first floor because they still have a good shipbuilding industry there in Brooklyn. He also converted the upstairs units for rentals, I believe is what they're used for, kind of like a B&B type thing, I believe. You go to the next one. And then this is the new Puritan Brothers block in the got stuff. I'm not sure why I included this one so much, but it was another, you know, excellent rehabilitations we've done in downtown Augusta. Go to the next one, please. And these are some examples of schools that were rehabbed and how gymnasium spaces. When the Park Service is reviewing these projects, they may divide the interior spaces up into what they call primary or secondary spaces. Primary spaces are typically corridors, stairwells, entry lobbies, gymnasiums, auditoriums, things like that, where people tend to congregate, or they're just open to the public. Secondary spaces might be, things that say nuns slept in a convent. They might be smaller office spaces within a building, bathrooms, kitchens, things like that, that can take, they can have more alteration done. The primary spaces, generally, you want to go with a lighter hand on those spaces as much as you can, but again, it's a consultation process, and part of this program is kind of, you can get into the weeds with this stuff, but it's really kind of a balancing act between, how much alteration is happening in one area versus what's happening in maybe a more prominent area or something like that, and trying to figure through that process. Which is why, because the standards are a little bit open-ended, it's difficult to come into those and just take the standard yourself, or if you're not familiar with them, and just try to look at these standards and then apply them to your project. It really helps to have someone with experience with this program helping to guide you through it, which is why I usually recommend a consultant. You got the next one? This is Coney High School in downtown Augusta, I mentioned earlier. It was a beautiful rehabilitation of the auditorium. Cynthia Taylor was the developer for that one, that was converted to elderly housing. Another great project because it's right in downtown Augusta. It's within walking distance to pharmacy, grocery store, all stuff that people need. And then this is a huge, amazing convent in Portland, Mother Mercy House. You may be familiar with it, right on Stevens Avenue. Another project that came out beautifully. It was converted to affordable housing. And next, please. And this is just my contact information and the information for Maine Revenue Services if you need them. I'm always available. You can give me a call anytime, send me an email. I'm happy to follow up on your specific project. If you have general questions or anything like that that may come up after this, feel free to give me a call or send me an email anytime. Yes, sir.
I didn't see any much regarding individual homes. Are they included in? I thought they were.
They're converted to income producing properties. But you cannot get tax credit for your own personal use residence.
But an owner occupied 2-unit would be considered eligible.
It can be, so if you have a 2-unit, so you got a duplex, you live on one side and now the other side. You can claim the credits for work done on the side that's rented out, but it's prorated to exclude the area that you use for your own personal use. It's very specifically a commercial tax credit. Now, go ahead.
Yeah, I was definitely. So we're part of the legislation that we're working on is to actually develop a homeowner tax credit. And so it doesn't exist yet, but we're very hopeful that we will be able to extend the credit, fix some things from the small deal fund that will make it more usable, and then create this homeowner credit. So as soon as we get a bill number, you will be hearing. So you can help us advocate for that, because that will be a really a game changer, I think, for all of us, myself included.
You had elevators not included. If that was the basis for being able to stay in that home. You said elevators are level, but not outside. You can't glom it onto the building. I think it's
And you can't get the credit for putting on the exterior. So like if you build a new elevator shaft on like an exterior wall outside the building that increase the footprint, you could not get credits for that. If you put a lift or elevator inside a building, you can't get credit for it.
You can.
Yes. Which can create conflict as well, because frankly, you know, if you try to put a building in, I mean, if you put an elevator shaft in a building and it has to go up through an auditorium or something, that's a difficult situation to work around. So, yeah. But that's, you know, the general rules of the credit are that exterior stuff is not qualified. Yeah.
So do you have a list of consultants that you recommend, and do you have any sense of what they charge per hour?
No, I can send you a list. I'm happy to do that. I do have, I have a list of architects, lists of consultants, lists of engineers. And lists of contractors that we send out when people have.
We also, on our website, portlandlandmarks.org, we have, the Northern New England Preservation Directory, where you can find a lot of that information too, but Mike does have yeah, thanks. I'm not sure what about charging.
Yeah,
We do have
That'd be a question that would come up.
we do have a tax credit consultant in our midst, but I'm not, no pressure, Chris.
that might be doesn't matter.
Yeah, I know. That's common.
No, yeah, I can't say what the consultants charge. I have a feeling it depends on a whole variety of different things, so. Yes.
Just one cautionary note about the use of grants. You've got to be careful. What brought this up is the question about the elevator in the back. I heard two things. Insurance proceeds, for example, if you have a fire during construction, insurance proceeds cannot be used as basis. I had a project like that where that happened. The settlement was $3 million. And they had to deduct that from their basis, so they ultimately dropped the project. They're using tax credits. There are certain grants that you can't use and claim for basis with the tax credits. And John, am I correct? CDBG is one of them under certain circumstances.
Right.
Yeah, so be careful of that. If it's federal money, you may not be able to use it for basis.
Yes.
Mike, we would never met, but I'm Roger Panic.
Oh, right.
Wanted to point out that the fees depend on the scope of the project, so you really have to know what the scope of the project is before one can quote a fee.
Right, that's kind of why, you know, it's hard to say what somebody would charge for any given project. They're all. So, that's all I've got.
Thanks, Mike.
Thank you.
Okay.
Do you want some more?
Sure. I don't need it now, but it sounds like I might need it.
Here. I neglected to let everyone know that we are gonna be sharing the slides with, so I can stop you to taking pictures, not that, shoot. So if you're furiously taking notes, we are gonna follow up with the slides and a recording of this today, so.
Great.
How about it, Sarah?
Give me 1 second to share the screen with our Zoom people and then, yeah. Okay.
Good afternoon, my name is John Egan. I work for the Genesis Fund, which is a nonprofit lending and technical assistance organization in Brunswick. We tend to focus almost entirely on affordable housing and community facilities for our work, but we also get involved in historic tax credits because that often, as Mike pointed out, a lot of those projects lead to affordable housing. I have been adjacent to, let's say, tax credit investing since the program started. The first project I did was in 2010. Early on in the slides, there was a picture of the Baxter Library. That was one of the first projects that I was attached to. Before I worked for Genesis, I worked for Coastal Enterprises, or CEI, and I did somewhere between 45 and 50 historic projects around the state. With a handful of exceptions, just about all of us deals that were in Mike's slides, so it's really nice to see them. And the Mayo Mill, the American Woolen Mill in Dover Foxcroft, could have its own workshop. It was really interesting.
I didn't even plan that, so.
So today I'm going to talk specifically about how you might consider converting the tax credit that you earn through the process that Mike just described into cash. How it's going to actually help you develop and pay for the renovation expenses at your property. I'll start at the top here and say, again, the tax credit has to be in an income producing property. So you can't live in the property and claim tax credits on the space that you live in. You can live in a building that is getting historic credits. You just have to take the unit that you're in, if it's a multi-unit building, out of the consideration. And the word basis, we throw that around if you haven't talked to your accountant in the last week and a half. The word basis means how many dollars do you have actually sitting in the bricks and mortar or wood timbers of the building. So it's what's, how much do you have sunk in it? What's your equity value? So when we talk about basis, it's the dollars that are sunk into the building. And that starts with what you paid for it. And then you're going to do renovations and it goes on top of it. And as Mike pointed out, in order to qualify for the federal credit, your dollars that you're putting in on top have to be bigger than what you paid for it. That's one of the main reasons why Maine has what's called a small deal set aside credit, is because there may be a place where you're going to do a relatively modest scale project and you're not going to spend $4 million. And you may only spend 200,000, but you have 300,000 in the building. You can still do that and get the state credit. You just can't get the federal tax credit. Okay, so now we can start.
Okay.
All right, so I already explained that. I have to say, because I work there, that we're a community development financial institution. And that's a mouthful. That's a US Treasury designation that we get as a nonprofit lender. You could also translate that to say it's a mission-oriented bank. We don't take deposits, we don't have tellers, but we're a lender and we're an investor. And we have a mission purpose on all of the activities that we do. So I'm going to share a lot of information today about the use of historic tax credits and how to convert that into equity. But our participation at Genesis would be if there is a component of affordable housing or some kind of community benefit or community facility. That doesn't mean that if you're not doing it, it doesn't qualify. There's plenty of projects that are completely market rate rentals in the use afterwards, and those are perfectly eligible. It just wouldn't be something that Genesis would get involved in. Okay, next one. Now I'll be happy to send these slides out to anybody that sends an email. I brought my old-fashioned business cards. All right, so what we're going to talk today is about how to convert the equity. We already heard from Mike about the process through the part one, the part two, the part three amounts of complexity, and they're extremely important to get them in the right sequence. And it's also extremely important to get them in the right month. When you're placing a building in service, that means when you're finished and you're ready to start leasing it up, it's really critical to know what year that project is in. So if you're placing a building in service around December, and I've seen this happen, and for whatever reason, a carpet cleaner doesn't come until January 4th, and you can't move people in until January 4th, you just lost a whole year of tax credits. So it's really important to understand when you place the building in service. So that's why the sequence is important. The ownership entity is also important because, as we've been saying, these are income generating properties. And so there is going to be a taxpayer that applies for the tax credit, both to the feds and to the state of Maine. And so you have to know that what your role is in that entity. And for most of the projects, you're actually going to invite the investors, we'll get to this in a minute, to join your entity that owns the property. In order for the investor to take the credit and pay you money for it, they have to join your ownership. So if you have a fourplex, and let's say it has a commercial space on the first floor, and you own it with your brother, and it's John and Dave LLC. when you go to take tax credits, you're gonna bring in, let's say, a bank to do the construction lending. Maybe that bank will buy your federal tax credits. Not only are they gonna loan to the property, but they're also gonna invest in your entity. They have to be an owner of record in order to take the credit. That's an important piece. We'll go over that a couple more times. Mike already mentioned how important it is to have a good team with experienced consultants. I promise I'm not here promoting the consultant industry, but I can tell you from experience, they earn their money. They absolutely earn their money in terms of figuring out problems and challenges, but also to get your deal done faster. Everybody would love to become a historic expert on how to put these things together. One of the projects that actually were on the cover of that journal that Mike showed, Seth Harkness and his wife, they do it all themselves. And I was the investor in that project, but it took them about 18 months to actually get it all done. Now, he had some real challenges with his construction, serious challenges, and he had to redirect a lot of water off the roof. We got there. I'm not saying that a project would have gone faster if he had a consultant, but it might have. So it is worth a lot to take a look at the value that a consultant brings. And I already mentioned about why the date's important. Next week. So we've heard some of the definitions of the phrases, the QRE or the qualified rehabilitation expense. That's the dollars that you're going to spend that generate the credit. So if you spend $1 on a QRE, you get 25 cents worth of state credit, or let's say you spend $100 on a QRE, you get $25 in a state credit, and you get $20 in a federal credit. And that adds up. If you're doing $500,000, that adds up pretty quickly. If you're doing a $10 million project, it adds up to a really big. Placed in service, I already mentioned that. I'm going to mention it again because it's really important. When you get the certificate of occupancy for your building, if you're finishing up in June or July or April or October, no problem. All those dates count as the year that you placed in service. That's only critical when you come to the end of the calendar year, which is also usually the tax year. And again, I'll say it, I watched a guy miss a whole year of credits because they thought they were going to place the building in service the last week in December, and it didn't happen until January. I also watched the opposite happen and have somebody get the Portland code inspector out to a building at 3:30 on New Year's Eve to make sure that certificate of occupancy said 2017 and not 2018. And that saved an enormous amount of money. Part 3, which is the final delivery of the credit. Mike went over the part 1, the part 2, and the part 3. It's surprising. It comes on a single piece of paper. It's a form from the Park Service. You've seen the form before because you would be filling out the numbers when you finish the part 2. And the only thing that comes is the signature on the bottom. And that is your $500,000 or whatever it is in tax credit. And that's the piece that you then share a copy with your investor, and they take it to the feds and to the state of Maine Revenue Service to get the credit value. Okay, next one. So Mike mentioned that it's really important to understand what your process is in terms of qualifying before you start work on the project. Not only is it important from a physical standpoint that you want to capture all of the information, physical, photographic, material choices in the property before you start work on it, but it's also really important from a tax perspective. Again, for your investor that's going to take those credits and pay you money, and I'll get to that in a second, how that works. They have to actually be in the project and taking a meaningful risk during construction. So I just had someone a couple of weeks ago call me up. They're finishing up a building. It's a relatively small scale. I think they spent a total of $1.5 million on the renovations. It's about 5 apartments and a couple of retail spaces. And they're just about to finish. They're expecting the certificate of occupancy in June. And they called me up because they got a referral to me. John, how do I get tax credits on this deal? I want to sell my tax credits. And I said, well, hang up the phone right now and go find someone. And it's probably going to have to be someone in your family because you're not going to find an investor who's going to take that risk. The federal investor has to be in the deal from the beginning. Maybe not from day one, but certainly not a month before you place it in service. If that investor were to ever get audited, and they do get audited, the feds have to look and see, in order for them to have this be a viable transaction, they have to be taking real risk. They have to have some equity in your project during construction. You haven't delivered them a tax credit yet, but they're taking risk because they put money into your project. It sounds arcane, but that's a real valid test for the federal credit's validity. So your investor, whoever you're going to sell your credits to, has to be in your project ownership before you start, or very shortly thereafter. One of the things that is actually really wonderful about the tax credit is like what you do other than living in space. What you do in the building is really not of much concern either to the state or to the feds in terms of eligible uses. You could be selling balloons, you could be running an Airbnb, you could have a pet store, you could do whatever you'd like in those spaces. However, you do have to make sure that your historic district or your downtown considers that as an allowable use. I've seen a number of projects where people try and put all kinds of commercial activity into the building, and then they find out that the local zoning, which has nothing to do with whether it's historic or not, says you can't do this use or that use. So you just have to make sure that you understand what's allowable in the space. And again, it's not a commercial for consultants, but experience really makes a difference with someone who's seen this stuff before. And it may seem like it's a lot of money, but that actually that part one, and even to a certain degree, the part two process can kind of come together much faster if somebody has done it numerous times before. And lately, maybe in the last 4 or 5 years, a lot of Maine community banks, at least 6 of them, have figured out that they can be a lender on the project and also be an investor in the project, again, if it's a commercial income producing property. And that's because the banks pay federal taxes, and they've now figured out, well, we've got this $280,000 tax bill that we owe the feds. Maybe we should go buy some credits in Frank's deal over here, and then we can offset that tax bill with an investment. They already know a lot about Frank's deal. They already know a lot about the project because they're lending on it, and they can manage their risk as an investor in the project because they're controlling it as a lender. So it's a really easy thing for banks to do, particularly if it's a small scale, small building where you're only doing a few units or one unit in a commercial space. So there are banks that are doing it. The challenge is that the banks don't have an endless amount of tax appetite. They're not making that much money. So they do run out, and they may offset their tax burden for this year and be looking at projects for next year. But if you're just planning now, that may not be a bad thing. It's also interesting to note that it doesn't have to be an institution that buys your federal credits. You can have an individual partner come in who has a federal tax appetite. That means they owe the feds a nice 5 or 6 digit number this year or for the next several years. And even if they don't owe, let's say you have $200,000 worth of federal credit and your investor only owes the feds 150, they can carry that 50,000 extra that they don't use this year to next year. So there is a value for them to stay in the project. Again, the investor is trading your credit, which comes on a piece of paper, in exchange for the bill that they owe either the federal government or the state government. In the case of a lot of projects that I was invested in as the state investor, the company that I worked for, Coastal Enterprises, was a nonprofit. So we didn't owe state taxes as a nonprofit. So we were able to claim the rebate. The rebate is delivered over 4 years. I paid the developer all 4 years worth today. And then I got the rebate back over 4 years. And for that exchange, I paid the credits on a discount, about 85 cents on the dollar. So the developer was willing to take a little bit less in the value of the credit because they were getting all 4 years worth of money up front. And then I was willing to invest in that project because I got them to put affordable housing in there. Some of the units, or sometimes all of the units. And then I would apply with that single piece of paper to the Maine Revenue Services and get the rebate staged over 4 years. So that's how it works. You're taking the credit and you're inviting an investor to come into your ownership of the real estate. And then the real estate collects the tax credit documents. The real estate entity files a tax return, just like you all file a tax return. And when you file a tax return, you attach the credit with it. And when you send that in, that wipes out your federal taxes for that year or whatever the allocation is. And it can do the same for your state. If you don't owe state taxes, Maine Revenue sends a check back, usually within about 60 days. So it's really just an exchange. You have credits that you earn because you did the work on the building. You don't have a tax appetite, but you can bring people into your ownership that does. And those people take your credits, they'll pay you money for it today so that you can use it to do the rehab work. And then they handle the rebate or the tax return process after that. So this is just some text here to explain what I was just talking about. Sign up your investors. Again, a good tax advisor can help you navigate through this to understand what your tax position is, what your investor's tax position is. And so you're selling, literally trading the tax credits to the investor in exchange for the equity. So when they give you that cash, and it's usually laid out in a couple of installments, you're using that cash to go spend money to fix the building. So if your building renovations are going to cost $1 million, you now have close to $400,000 by the time you pay the discount. You have close to $400,000 that you got from your investors between the two credits. Well, now you only have to go borrow $600 to do your work instead of $1 million. That's the value credit. That's where it really delivers into your project. So you would use that equity to pay down a construction loan, or maybe not even borrow the construction loan money if you can have it available during construction activity. Next slide. There is a timing thing to be aware of that your investors are going to stage out when they pay in their equity. Not all of it's going to come in during construction. Usually about 20% does, and you can negotiate that. You might be able to get them to put a little more in. But when you finish and you get that certificate of occupancy and you get the Part 3 single piece of paper and you get a cost certification, those three things are the trigger for all of the rest of the equity to come in. Now, hopefully that's within about a month or so when you're finishing the building, maybe 2 months, and you turn around, you take that cash and you pay down your construction lender. So your loan was $1 million during construction. Now you use this equity, now it's only $600,000, and that becomes the balance that you move forward with as your permanent mortgage on the building. So it's really kind of just a hopscotch game. You're trading tax credits for equity. There's some timing about when those things come in. Deliver the Part 3. Your accountant delivers the cost certification, and your local municipality delivers the certificate of occupancy. Those are the three big ones. There's a few other little things. You have to have insurance. Somebody has to do some final inspections and photographs and such. But those are the three big documents that drive the tax credit process. So when somebody's going to give you $600,000, so if you're talking that the investors they take a 9 is because the tax credit is allocated to the partners in the building. So if you're not using the tax credit, you want to give as much of it as you can to your investor partner. So they will take 98 or 99% ownership for the 5-year period. They'll work out in that agreement. You still run the property, you lease up the units, you're responsible for maintenance. You get to decide if, you know, you're gonna plow the driveway at 3 o'clock or 5 o'clock. Your limited partner or your investor partner stays quiet. They don't get in your hair about how the place is operated. But on paper, they own the majority of the building, so they can take the tax credits. So it's kind of a tax structure only, even though it's kind of scary. They think, wow, I just turned over 99% of my ownership to somebody else. And then the delivery of the tax credit comes through their tax return that you collectively get for that building. Even company-owned real estate has to file a tax return. One thing that's in here is that I didn't spend a whole lot of time on is that if you're going through this process, you can earn what's called a developer fee. If you're handling all of these dynamics, you can actually pay yourself for that time. And that's an eligible item. That dollar that goes towards the developer fee counts towards the tax credit. So if you're spending $1 million on your project, you can charge up to 15% developer fee. So that can be another $150,000. So now it's not $1 million project anymore. Now it's $1,150,000, and that's what the credit gets calculated on. And that $150,000 will be a developer fee that you can take. Your developer fee is paid by the equity from the investor, not from your loan. And so it's usually the last thing that gets paid. They want to make sure you've done everything to meet all the criteria. And again, that single piece of paper. You all get that metaphor. It's amazing. It comes on a single piece. So there's a small distinction in how the state credit can join your ownership entity. I mentioned before that in order to claim the tax credit, the investor has to be in your ownership entity. That's not entirely covers all, that doesn't entirely cover all the possibilities. If you have an opportunity and want to simplify things and not have an investor come into your ownership, you can actually borrow the money. You can borrow it from your bank. If you're doing affordable housing, you can borrow it from me, the Genesis Fund. You can borrow it from CEI. I'm sorry, CEI does the investment part. But there's a number of other lenders out there who will make a loan against that refund of the credit. Remember, if you don't have an obligation to pay the state of Maine, you've got a $50 credit and you only owe them $10, they're going to send you $40 back. So if you see that ahead of time and you can predict what your tax status is going to be, if you've got a brand new entity that doesn't owe anything to the state, then you're going to get all of that rebate back. And you can show that ahead of time to your bank or to your lender, and they'll make you a loan for largely that whole dollar that's coming back. And that's what Genesis would do as well. So there is an alternative if you don't want to have an investor, a state investor, come into your entity and be a co-owner. You can actually borrow that and pay it off with the once-a-year rebate that you're getting from Maine Revenue Services. The lender is going to make sure you're following the procedures to qualify for all the credits. And they're also going to make sure that you file a tax return timely every spring with Maine Revenue Services. And ask for a copy by a certain date, for instance. And then when you get that rebate, you take that, it comes 25 cents each year on the dollar, 25%. You take that rebate, it comes once a year, and you turn around within that same month and you make a loan payment once a year against the tax credit bridge loan. So that's another way to take your tax credit and turn it into cash. So you borrow that money up front. You can use it during construction. There is an interest cost ticking, but no payments iterations that your design team is all of this, but certification, your certificate of occupancy, and the Part 3. Those are coming from 3 different players. You want them all dancing on the stage at the same time. So you want to start talking to them about 2 months before you finish, so that everybody's aware of what everybody else's time frame is. And the big one is the certificate of occupancy, because that establishes the date. Again, particularly if you're in December, that's your most important ball to watch. You don't want to miss that year-end date. And you want to be sharing with your accountant who's going to do the cost certification, all of your monthly requisitions that you've paid for all of the work during the construction process. And then you would submit all of that at the end to the Park Service to get the Part 3. So those 3 things come from 3 different places. It takes a lot to line them up so that they're all hitting at roughly the same time, but that's the goal. It's very rare that they all show up in the same week. Next slide. Okay, I just talked about this, but the next one. The payday. So, as I mentioned, the investor is going to pay some of their equity, 20% during construction. Particularly your federal investor has to show that they took some real risk during construction with you. But then their big chunk of equity, 80% of it, is going to come in when you deliver those 3 things, when you get that ballet really on stage lined up, and those 3 things come in. And then you use that in infusion of cash to pay down your construction loan, clear up everything that the bank wants you to clear it up, and then you move from construction to permanent phase in terms of your finance. Next. So I mentioned that the uses in your building can be wide range as long as they comply with your local land use ordinance. So the Park Service is not concerned if it's apartments or Airbnb or hotel rooms, or if it's commercial, or I'm not even sure that if you have I'm not sure that even cannabis activities are prohibited in. I think the federal government is looking the other way if you have a retail shop that's using it. I used to be the only one that was excluded. I think that was there was a question about nonprofits. Nonprofit owners can use the tax credit, but leasing to a nonprofit. So let's say you're a nonprofit organization and you own the Woodford's Club, and you want to have tax credits for the renovations. It's difficult for a nonprofit owner to apply for and get credit for to get the credits because you're not a taxpayer. So the easier pathway is for a 5-year period. The Woodford Clubs, for instance, will transfer the deed of the real estate to Woodford's Rehab LLC. And that would be the entity that the tax credit investors come into on paper. On planet Earth, it doesn't change. There's no sign out front. You just see the normal renovations going on, and it would happen. And then at the end of the construction, Woodford's Rehab LLC would file the tax returns, collect the equity from the investors, and go about that process that we just talked about. The challenge is if Woodford's is the leasing tenant in the building after the building is placed in service, you have to really go far to prove to the federal government that the lease is not a discount. And that's often a challenge because the Woodford Club owned the building a year ago. We weren't paying any lease payment. We owned it. So now you're telling us we have to pay a lease payment? So that's a weird structure for a building owner that's a nonprofit that's used to being in their building, nothing but operating expenses. They don't have, they're not paying a lease payment to then have to go to being a leasing tenant for the 5 years. And that's to ensure that the property is a commercial income producing property. So a nonprofit quote, living in the building, like the Woodford's Club in this building, or like one of you in one of your historic homes. You can't, you have to be a tenant in there, not an owner occupant. And that's the hard and fast law with vets. So you can get around it by doing these kind of weird structures, and you can have the lease that the Woodford Club would pay to the LLC, come back a later date, and when, so you get your lawyer in there to figure it out. And there are ways to figure it out, and certainly some have done it. But it is a bit more challenging. The other thing, if you're doing renovations on a residential property, for at least 5 years, all those units have to be rented. You can't sell them off as condos, because then that's not an income producing property anymore. It's ownership and it's owner occupied. So that's really important. When we look at these large mill buildings, or actually not far from here is the what's the school? Nathan Clifford School over here in the USN neighborhood. That was a historic rehab project. All along, those tenants knew that they were going to be available as condos, but for 5 years, they all had to pay rent. After the 5 years were over, the residents had their first chance to buy their unit if they wanted to buy it as a condo. They can't do it during the 5-year compliance. And the structure that you create with your investors does eventually dissolve, usually at the beginning of year 6. So after your 5-year compliance, maybe an extra month or two, just to make sure that we've met all the compliance, then your investor would leave and you would return the building to whatever ownership structure you want it to be. Next. So I'm talking a lot about all of the mechanical steps, but again, to get back to the real value of the credit, why you would go through all this craziness. If you're going to spend $100 on rehab, $45 at a gross level comes from somebody else. That's somebody else's equity. So you don't have to borrow the whole $100 to do the work. That's really the lever of the credit. And it can take a project that is sort of on the margin. Maybe I can swing it, maybe I can't. If I don't do all of it, then I'm not going to get my designation from the Park Service, and then my neighborhood's going to be mad because I didn't do this side of the building or whatever. So the credits can make a marginal project really go, because you can bring in so much equity. There is some overhead, there's some top end stuff. Consultants are a good idea, not required. And you have to pay an accountant and an attorney to help you navigate those procedures. But they're not crazy. It's a hopscotch, but they all make sense. And again, you can look for finance partners to buy your credits. I mentioned Genesis can be an advisor if you're doing some affordable housing units in there, and or a community facility like a food bank or a job center or a cultural center for a local community, whatever it might be, that's got public benefit in there for our nonprofit status, then we can be an advisor to that. And again, I put this in here. Ultimately, you still get to do what you want to do, which is fix up and renovate your historic building. There's some tools here to make it a little bit easier financially, and there's some good guidance out there to help you navigate all of these gates. And it does seem like a long time, but actually after 5 years, all of that craziness goes away, and you're back to just having your building and it's now fully renovated. All right, so there's my contact information. I have business cards here. Please take one, send me an email. I'd be happy to send you these slides. I can send them to you on a PDF so that it doesn't jam up your inbox. And you can call me up with questions after you get a chance to go through them. Great, thanks.
Thanks, John.
Questions? Yeah.
So if I understand it correctly, though, it's 45% credit. When you sell that single piece of paper that you emblazoned in my brain now. When you sell that to an investor, that comes in as a loan. It doesn't come in as a capital gain or anything like that. It's not a sale.
No, it's actually equity. That's cash, not a loan. Okay. So the investor is buying, you're selling the credit and they're paying you money.
Right, but there's no liability, tax liability to me if I sell that credit.
No, because they own 99% of the building, so that's the reason why you want to flip the ownership to them, so they can claim all of that credit. There is a small little catch that if you're going to do, well, there's a lot of small. But that I want to point out
More than one piece of paper.
is that if you decide to take the state credit yourself because it's refundable. And you don't need all 4 years worth in order to make your construction activity work. So let's say your project is modest and you don't actually need to sell that. You can manage that with a bank loan and you're just gonna collect $25,000 each year because you don't owe the state anything for whatever reason. You're gonna collect $25,000 in rebate each year, or let's say it's 20, right? You'll generate those $5 grand, they're gonna send you back 20. That 20,000 rebate from the state is a federally taxable event. So if you don't have another place to shelter that income, like an operating business that has losses and depreciation or something else in your tax status, that 20,000 rebate from the state becomes a taxable event for you on a federal basis, which is why a lot of developers who are building these projects and they're generating $1 million or $2 million or $3 million in state credit. Yeah, they could probably offset their taxes with that for the next however many years. You can carry that forward 10 years. But that state rebate then creates a federal tax obligation. So that's why over a certain dollar amount, it really makes sense to syndicate both credits and let somebody else worry about the tax. And you just get the equity. Yes,
You talked about 20% during construction with the investors. Is that a negotiated number or is that a prescribed number?
on the federal side, it's a minimum. So your federal investor is probably going to force themselves to put at least 20% in. They're going to say, hey, we're paying this because we have to do it for our tax compliance. You can negotiate a little bit higher. And so you might take a little bit less. So instead of selling them the credit for 85 cents on the dollar, maybe you can negotiate to sell them 84 cents on the dollar, but they give you more of it now.
Right.
So you could, it's a back and forth. It's all about dollars and cents for them.
And then you mentioned 6 local banks. Do you have, is that something you can share with the neighbors?
Yeah, Norway Savings. Used to be Mechanic Savings, now it's Maine Community Bank, Gorham. Bath Savings. Camden National has done it occasionally. And TD's buying state credits. I'm sorry, federal credits. Oh, okay, that's,
I've got a project.
yeah, that's great.
What about Bangor or Andrew Scott?
Bangor claims that their mutual status eliminates their need for having to accumulate tax benefits because they distribute it. And Andrew Scott has not engaged yet. There's another bank, I can't remember which one it is now.
Forum?
Yeah, I mentioned Gorham.
Saco and Biddeford.
No. Biddeford Savings and Mechanic Savings joined to form Maine Community Bank, maybe that's what I'm thinking of. So they're doing it, they have a banker, they're guy named Justin Bavaria, who is, there's like 9 of them, he's everywhere around the state, finding his tax credit deals.
Yeah.
And he's very hungry as a banker, so he would be somebody to call out. I think that's. Yeah, I guess that's all, I thought maybe there were 6, but maybe it's just 5 then on that version.
That's great, thank you.
Yeah. All right, well, please come take a card if you still use those. I don't have the app on my phone, or I can just slash it.
Sarah, are there any in chat?
No, we haven't had any questions for that. You answered
Okay.
all everyone's questions. All right.
Someday I'm gonna get one of these owls.
All right.
All right.
Thanks all.
Thank you.
you. We will sign. Yep.
August in the meeting.
Yeah, I'm just typing, hold on, you're gonna meet live, and, there's 4 days at the meeting, and follow up, like, send contact information. Yep, yep, I've got all your email addresses, so I will get that out. Oh, that's cool. LR.
Yeah.
We're waiting for an LD number. We don't have an LR number, but,
Okay.
we-